I'm Greg Hunter. Welcome to USAWatchdog.com. With us once again, economist John Williams at shadowstats.com. John Williams, thank you for joining us today on USAWatchdog.com.
Greg, thank you so much for having me.
You know, you had been saying for months now, and even when they were saying, oh, we've got this, for years, you've been saying we've been bottom bouncing and we don't really have a recovery, which I've been taking your lead and saying the same thing. But the first quarter, you said, would come in negative, and the first run through with the GDP came in at negative 0.7%. They revised it, still negative 0.2%. That's the best they could make it look. Bravo, my friend. You made a big call. What do you suppose the second quarter is going to do with the now Dow Transport's new information that it continues to slide down, which means they're not shipping goods? What do you think about the second quarter?
Well, I'm looking for an outright formal contraction in the second quarter as well, which would give you a formal recession. Two back-to-back negative quarters in the GDP would be counted as a recession. The problem here is GDP is very heavily bloated and inflated by all sorts of gimmicks. They had inflation numbers that they use in deflating their numbers. And in effect, we're seeing a weak enough economy now that it's actually dragging down these bloated numbers. I contend that we never recovered from the economic collapse into 2008, 2009. I mean, you've had some bottom bouncing, but where the official story is that the economy plunged into 2008, 2009, and then rebounded. Right now, they've got the economy up 9% above where it was at its peak before the recession. I'll contend that as we tumbled into 2008, 2009, we just saw a period of low-level stagnation. It's moved a little bit higher, but not much. And now that the economy's down, order of magnitude 7% from its pre-recession peak. So you have a difference there of about 15 percentage points. It's beginning to turn down again. We've seen that in a number of statistics. We've also seen some stronger housing numbers the last couple of weeks, which have people looking for maybe 2% growth in the second quarter. We have some significant reporting ahead. I'd watch the trade data. You see a widening of the trade numbers there. The expectations for the second quarter GDP will begin to sink.
So you're projecting another, even with the gimmicked up, what you call heavily gimmicked up GDP numbers. That's that's your words. You think that even though they're going to be heavily gimmicked up, we're still going to get a second quarter contraction when it's all said and done.
That's my bet.
What do you think they're going to do are they going to push the panic button if they get a official recession? Are they going to push the panic button and start printing money? Are they going to just try to jawbone this? I mean, what do you suppose they're going to do in their plan? And why do you think they keep talking about raising interest rates when obviously they know what you know? They may not put it out there. Why do you suppose they're talking about raising interest rates even though they know the economy's sinking?
Well, there's not much they can do, at least nothing that's very constructive. The panic of 2008 was a circumstance where the system was threat of collapse, and the federal government, the Federal Reserve, did everything within their power to prevent a systemic collapse. They couldn't allow a systemic collapse, and the fixes were all over the place. There was none of the underlying fundamental problems in terms of the broad gap basis, the long-range solvency problems of the United States, the lack of liquidity among consumers, the general economy. None of the issues there were addressed. None of them were acted upon to improve them. It really wasn't too much they could do politically, but they bought some time and pushed things into the future. We're now into the future. Economy getting enough worse that even the headline numbers are turning down again. The Fed wants to raise interest rates. There's not much the Fed can do to stimulate the economy. Ben Bernanke expressed that the low interest rates are not necessarily an economic stimulus. I mean, they help in certain areas and maybe in terms of mortgage costs and people buying houses for the first time. But in there, the problem is the banking system's not normal. It hasn't been lending in a normal fashion. All the big easing that the Fed did was aimed primarily at supporting the banking system. Was not aimed at supporting the economy. The economy's been used as sort of a scapegoat. Oh my goodness, the economy's weak, therefore we'll do the easing. But it was used as weak economy's been used as political cover for bailing out the banking system. Now, they had an opportunity. I guess it was a couple of weeks ago in mid-June to raise interest rates. They could have done it then. They'd had a spate of stronger numbers, such as the very volatile housing statistics. They're going to pull back again in the next month or so. But there's a period of time there they could have raised rates. And actually, raising rates might be better for the economy from a couple of angles. One, it enables banks to make a bigger profit margin on their lending. And if they've got a bigger stress, they're able to lend to less credit-worthy customers. So you see more of an expansion of credit, which tends to stimulate economic growth. You have a lot of people living on fixed income or would like to live on fixed income, but they can't go out and get a CD that gives them a return that beats the pace of inflation. They're being killed in terms of interest income. All those things, I mean, if you have higher interest rates, people will have a stronger interest income. But those are things that would actually be a positive for the economy. The thing is, the financial markets are afraid of the higher interest rates, and the Fed's afraid of what's going to happen to the stock market.
Well,
raise rates, but they can't. They will not be able to. At least they're going to have a very difficult time politically raising interest rates if the economy's in a formal recession.
Okay, so we already got a negative first quarter print, even though it's revised to a negative 0.2%. You're saying, by the looks of things, that the second quarter will also be negative. What do you suppose their reaction is going to be if they have two consecutive quarters, which goes ding, 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 we're in a recession?
Well, it'll make it very difficult from a practical standpoint, from a political standpoint, for the Federal Reserve to raise interest rates. And a lot of the recent strength that you've seen in the dollar, for example, and then you go back to last June or July, you'll find the dollar really has went through a very strong rally due to a couple of factors. One of the most important, has been the expectation that the Fed is going to back off its quantitative easing and move towards more normal monetary policy and raise interest rates. Higher interest rates are usually a potent tool for strengthening a currency. So a lot of the dollar strength here has been tied to the perception that the Fed was going to raise rates. You have a recession, that's going to disappear pretty quickly, that expectation. In fact, there are going to be calls for quantitative easing. All of that will tend to hurt the dollar. All of that's going to tend to hurt the financial markets. It'll tend to spike oil prices. It'll tend to accordingly boost inflation that we see, as reported and as people see it at the gas pump. Gasoline prices will rise again.
And I have Greg Manarino on this program a lot. One of the things he brought up he says it's over, that the economy is going down. You've been saying that too. He brought up the Dow transports, which I'm sure you cover, and he says, listen, it's in a clear downtrend. We had more news out next week that the Dow transports took another leg down, which means if they're not shipping goods, you don't have a growing economy. Well, what do you think about that premise that that's a sure tip-off that we got a sinking economy?
We have a variety of indicators showing that, and some that are beginning to get people excited that maybe the economy is growing, but the better quality numbers are showing that the economy is sinking. For example, industrial production, published by the Federal Reserve, has contracted in the first quarter, and it's a virtual certainty to contract in the second quarter. We've got reporting through May. You'd have to have extraordinary growth in June to prevent a contraction. It does on a quarter-to-quarter basis unless you're in recession. Year-to-year growth in industrial production is at a level that you only see going into recession. I think it's down to 1.4%. New orders for durable goods. That's a leading indicator to industrial production. Contracted in the fourth quarter, contracted in the first quarter. It's basically flat in the second quarter, which might offer a little bit of hope in the production number ahead. But even there, I think that's going to be down for the second quarter when all the numbers are in, and that'll indicate further contraction in the third quarter of this year. Where you've had some stronger numbers in just the last month or so have been with the housing report, the home sales, the housing starts. But those numbers are highly volatile. They're not. They're extremely unstable. You have to look at basically smooth for maybe 6 months to get a legitimate pattern. And the pattern generally has been one of stagnation, low-level stagnation. Again, you look at those numbers, you're still, depending upon the measure, you're down 30 to 60% from where you were before the recession. And you look at the pattern of the let's say the new home sale, flat, maybe a little bit of an uptrend, but even there you're seeing some downturn. So those numbers I expect are going to turn down in the a month ahead of reporting. Again, that'll start to knock expectations in the trade deficit, big factor. Deficit still deteriorating, and a negative trade deficit is a negative for the economy. Because what that reflects is an excess of imports. You're buying more than you're selling. And in theory, if you didn't have the trade deficit, you'd be manufacturing those imports. So a trade deficit is counted as an economic. And that's I think, going to be a big contributing factor to get through the next two reports here before the initial estimate of the second quarter GDP, which comes out on July 30th.
And I just want to return to, and the reason why I wanted to kind of revisit that before we moved on is because the premise of the economy sinking, the economy going down, first quarter negative, second quarter likely negative, and you just laid out the signs, that why it's going to be negative. And I want to come back to your hyperinflation scenario, which you pushed back into this year. And that the beginnings of hyperinflation will start, and you think they'll go absolutely crazy, and they'll start printing money to bail out the system? You think the system will start getting into deep trouble?
Yeah, well, the system has to. You have to go along a little bit here and have the dollar under heavy pressure, and the system will be in trouble, and there'll be all sorts of things happening that'll start to spike inflation. I was looking for a hyperinflation in 2014. What I did not expect and what I had missed was the big rally that took place in the dollar middle of last year. Now, if you look at the big rally in the dollar and the sharp sell-off in oil prices, that was all timed within a day or so of the U.S. taking official sanctions against some Russian officials tied to the Ukraine situation. I think generally it was an artifact, an effort to try and use some covert financial pressure to hurt the Russian economy, financial system, and to pressure the Russians to do what we wanted relative to Ukraine. Now you saw the decline in oil prices, the rally in the dollar. That pretty much continued into the early part of this year. What the markets did was they picked up on the Fed. Fed was used as the point issue here in terms of justifying the dollar's strength. The Fed's got to lower interest rates, raise interest rates because the economy is improving. But the economy is never improving. Now it's not only not improving, but it's beginning to turn down again. And that's the importance of the quarter-to-quarter contractions, because you get quarter-to-quarter contractions, you have official recognition that the economy is falling, that it's not recovering. And so as the expectations wane on the Fed tightening, you will start to see the dollar selling. I think you're going to see a panic decline in the dollar at some point, massive selling of the dollar that'll take it not only below levels where it was a year ago, but to historic lows. And as that happens, you'll see a tremendous spike in oil prices, which will start moving the consumer price index with higher gasoline prices. You'll start to see that pick up. At the same time as the dumping of the dollar gets very heavy, you have an overhang of in excess of $12 trillion outside the United States. All that will be, a goodly portion of that will be repatriated to the United States, into the U.S. markets. The people are going to be dumping the dollar to get out of the dollar. The Fed's going to have, it's going to be monetizing all sorts of things, and that's where you'll start to see the monetization pick up. The Fed did some very funny things in the last year or two with its quantitative easing. It actually, again, quantitative easing QE3, those actions are largely aimed at helping the banking system. But in the process, and the Fed buying all these Treasury bills, notes, bonds, it effectively monetized 75% of the federal debt issuance in 2014, and that should be highly inflationary. It wasn't, because they kept the funds from flowing into the money supply. In order for those funds to flow into the money supply, you would have to have had something akin to normal lending by banks, and you haven't had that. It is through the bank lending that you get the cash into the system. And we'll see how all that plays out. But right now, what's out of whack against reality is the strength in the dollar. We don't have a booming economy. We don't have a Fed that's going to happily raise rates, although they'd like to. And as the realization there sinks in, you have to watch what happens to the exchange rate value of the dollar. It'll start falling. You'll actually have a panic. And once that has happened, then you're at a position where you should start to see a sharp upturn in headline inflation, and that will evolve into eventually into the hyperinflation.
We have trouble in Greece, and Greece, they're running up to a deadline, the 30th of June, when I don't know if they're going to extend it. I don't know if they're going to give them money. I mean, they've been kicking this can. They would have been expecting it for the can to go over the cliff, but they keep finding, more room on the cliff. And if we do have a problem in Greece and they do default, what does that do to your scenario? Doesn't the euro come under pressure and then maybe the dollar spikes again? Or it all starts to unwind?
Well, we'll have to see what happens there. I think eventually the euro is going to be broken up, or maybe it'll be organized into a couple of euros or such. I don't know, and I don't think anyone does at this point. That actually would be a positive for the global system. The euro never was designed to work. There's no way you could get the countries that were not conservative with their fiscal policy, such as Italy and Greece and France, let's say Germany, where they always were very tight in controlling their fiscal circumstance. Without having a general agreement, you could force the system to do it. They never did that, so it's that there would eventually be some kind of a breakup was almost preordained by the way the system was set up. If something happens here, yes, you may have some increased weakness in the euro, but the flight from the euro, relative to the euro, certainly would tend to the dollar might see some flight, but you're going to see a flight to other currencies as well, such as the yen, such as the Swiss franc, Canadian dollar, and increasingly people are not going to want to get into the U.S. dollar. So the movement will generally be away from the dollar, particularly after you get through whatever bump in the road you get from this Greek circumstance. I don't see it as being more than a bump in the road. I don't see a fundamental downshift in the value of the euro as a result of this. I think you'll see have a breakup, and whatever the unit is that ends up with Greece in it is not going to be a strong currency, but whatever the unit, which is still the dominant economy in the system, and what would be the dominant currency would actually become a strong currency and a good currency for absorbing flight from the dollar once the breakup happens.
If we have a panic out of the dollar and we start getting to the point where they have to do something to the economy, to your point, start printing money and start monetizing debt and all that, could there be a panic into gold, out of the dollar and into gold?
I think you could certainly have that. You'll certainly have a flight to gold, and you'll see the gold prices rally. And their central banks don't like to see that, and they've orchestrated all sorts of interventions over time to depress gold. But the thing here is where the precious metals, gold and silver, will preserve the purchasing power of the currency put into them. And that's a way to ride out something like a hyperinflation crisis. You'll have your ups and downs, as we've seen in the last several years, but it provides you with a good store of wealth, solid store of wealth, that will retain its purchasing power through a crisis and provide you with liquidity and following the crisis. So if people buy gold in anticipation of a crisis here or in response to the crisis here, my suggestion would be that you hold it through the crisis and let it do its work as a store of wealth.
Are you worried about this thing blowing up this fall? Many people think this fall is good. If your scenario happens and we have 2 quarters in a row, and then they announce it in July, which they'll know ahead of time, that's pretty much sets up, August, September. It's pretty much sets up we're going to have some sort of calamity if your scenario plays out. Do you think we might have rough sledding this fall sometime, September, October, November?
That's always a positive. I gave up a long time ago trying to time things so precisely. The fall traditionally is a time frame where the financial markets can get hammered, and I think we've discussed it before. That there is some rationale behind that. Back in the late '80s, where we had the crash in '87, I consulted a mass psychologist in terms of trying to explain why stock crashes tended to take place in October and November. The residual swirling instinct with humans, and the weather begins to change. The squirrels put away their nuts for the winter, and humans begin to think, well, maybe I better be a little more cautious here. And something helped trigger a stock crash, but if things are not right, it's not going to happen. It can be the timing. That period of the year can contribute to having a panic, but it's a contributor. It's not a determining factor. But it's certainly within that time frame you could see something happen. I'm not predicting it, but I sure wouldn't be surprised.
And last question, the last we talked, you were saying that we were growing our national deficit, not 400 billion or 300 billion or 500, whatever gimmicked up number they come up with. Are we still growing our national deficit at 5-6 trillion? A trillion a year? Not 400 billion, not 500 billion, but 5 or 6 or 7 trillion a year. Are we growing our national deficit in that kind of order of magnitude still, in terms of counting everything, counting all the expenditures, everything you're on the hook for?
Right. Right now, it's order of magnitude of 5 trillion. Total, it's order of magnitude 100 trillion. That's net present value. Effective funds you need in hand today to cover the future obligation. That is just 5 trillion a year. It's varied some over the last couple of years, and they keep changing the accounting system. But I think 5 trillion is probably a solid estimate at this point in time. As to the annual.
Yeah, 5 trillion a year is what we're really on the hook for. Which brings me to the question: how much longer can this go on? How much longer can you accumulate debt and deficits and commitments at $5-6 trillion a year? Well,
As long as people are willing to buy the dollar. You have a circumstance here that is we saw fall apart a couple of years ago when they had a big argument over the deficit, and S&P downgraded the U.S. Treasuries. We almost had the dollar panic at that point in time. Dollar panic is reflective of the problems here.
And you're saying at some point everybody's going to go, this is it, we're out, we're sell.
I'm sorry, could you repeat that?
At some point, foreigners are going to say, game's up, game's over. We're selling the treasuries, dollars, whatever we have dollar asset, that's more than 12 trillion, according to you, outside the country. Foreigners may just sell. At some point, there's going to be you're predicting at some point, there's going to be a dollar panic and people will sell it.
Yes, and the reason for that, again, is because of the long-term sovereign insolvency of the United States. There's no way the United States can pay off the obligations that it has committed itself to. It's a physical impossibility without debasing the currency. That's what the rest of the world recognizes. That's why you had a dollar panic that began with the credit downgrade of the U.S. Treasuries, all sorts of efforts made by the members of the financial system, global banking community to prop up the dollar at that time. They did so successfully. But you saw the fundamental lack of confidence in the dollar there. And again, the crisis, the determining factor in terms of when they say enough's enough, will be that dollar panic. You see the dollar panic, that's the message. U.S. just is not going to get its financial house in order. That's what they're telling you. That's what they've concluded.
John Williams, shadowstats.com. Thank you for joining us.
Thank you for having me, Greg.